The silver market just did something extraordinary. For the first time in history, spot silver crossed $90 an ounce in December 2025. That's a 140% increase since the start of the year. But here's what most investors missed. While silver prices surged, certain silver mining stocks didn't just follow along. They absolutely crushed the performance of physical silver itself. Hecla Mining shot up 291% in 2025. The Global X Silver Miners Junior Exchange Traded Fund, which tracks smaller silver mining companies, surged 196%. That's 47 percentage points more than physical silver's already impressive gains. This isn't just interesting, it's a signal of something much bigger coming in 2026. Today, we're diving deep into why silver miner stocks could dramatically outperform the price of silver itself this year. We'll examine the structural supply deficit that's been building since 2021. By the end of this video, you'll understand the mechanics of operating leverage that allow miners to amplify silver price movements. You'll learn which specific catalysts could trigger massive moves in miner stocks. And you'll discover why some of the smartest institutional investors are quietly accumulating $100 million positions in this sector right now. Let's get started. To understand why silver miners can outperform silver itself, we need to talk about a concept called operating leverage. This is the secret weapon that makes mining stocks so powerful during commodity bull markets. Imagine a silver mining company that produces 1 million ounces per year. Their all-in sustaining costs, which include everything from extraction to refining, average $50 per ounce. When silver trades at $60, they make $10 profit per ounce. That's $10 million in annual profit. Now silver rises to $80 an ounce. Their costs stay relatively fixed at $50. Suddenly they're making $30 per ounce. That's $30 million in profit. The silver price increased 33%, but their profits tripled. That's a 300% increase in profitability from a 33% move in the underlying metal. This is operating leverage in action. History shows us this pattern repeats. During the 2010 to 2011 silver rally, when silver went from $18 to $48, many major miners saw their stock prices increase by 300 to 500%. Right now, in early 2026, we're seeing the same setup. Silver has already made its initial move. But most miners are still trading at valuations that reflect $50 to $60 silver, not $90 silver. The key difference between owning physical silver and owning miners becomes clear. Physical silver gives you one-to-one exposure. If silver goes up 20%, your investment goes up 20%. Miners give you leveraged exposure. Now, let's talk about supply. Because what's happening with silver supply is unlike anything we've seen in modern commodity markets. Silver has been in a structural deficit since 2021. That means global demand has exceeded mining supply every single year for the past 4 years. The cumulative supply shortfall from 2021 to 2025 approaches 800 million ounces. Where did that silver come from? Above-ground stockpiles, recycling, investment liquidation. But here's the problem. Those sources are finite and getting depleted. The Silver Institute reports that visible inventories at major exchanges have dropped by 40% since their peak. And UBS, one of the world's largest banks, projects an even larger deficit of 293 million ounces in 2026. Think about what this means for miners. They're producing a commodity where demand consistently outstrips supply. Every ounce they pull from the ground has a guaranteed buyer. There's no inventory glut to worry about, no price-crushing oversupply scenario, just persistent, growing demand meeting constrained supply. But why can't the mining industry just produce more silver? The answer reveals why existing producers are so valuable. Silver deposits take 7 to 10 years to develop from discovery to production. You need geological surveys, environmental permits, infrastructure development, and massive capital investment. Even if companies started developing new mines today, they wouldn't produce an ounce until the early 2030s. Meanwhile, existing mines are depleting. The average silver mine grade, meaning the concentration of silver in the ore, has been declining for decades. Miners have to process more rock to get the same amount of metal. Add to this the geopolitical factor that's now dominating headlines. Countries are racing to secure critical mineral supplies. China imposed export restrictions on refined antimony and other materials in late 2025. President Trump set a 180-day deadline to counter China's control of critical minerals. Nations are realizing that industrial metals aren't just commodities, they're strategic assets. This creates an environment where companies with operating silver mines become extraordinarily valuable. This is why we're seeing the beginnings of a merger and acquisition wave in the sector. Industries dependent on silver for manufacturing can't risk supply disruptions. They're willing to pay premium prices to acquire mining companies and guarantee future production. For investors, this supply deficit translates directly into pricing power for miners. When you control scarce assets that the world desperately needs, you can command better terms, higher margins, and premium valuations. While investors often think of silver as a monetary metal or inflation hedge, the real story in 2026 is industrial demand. Silver is the most electrically conductive metal on Earth. It's also highly thermally conductive, corrosion resistant, and has unique antibacterial properties. These characteristics make it irreplaceable in modern technology. The numbers are staggering. Demand from the electrical and electronics sector has surged 51% since 2016. This isn't a temporary spike. It's a structural shift driven by three massive technological trends: artificial intelligence infrastructure, electric vehicle production, and solar panel manufacturing. Each of these megatrends consumes enormous amounts of silver. Let's start with artificial intelligence. Every AI data center requires massive server farms with sophisticated cooling systems, high-performance conductors, and dense circuit boards. Silver is essential in these applications because of its superior conductivity and reliability. As companies race to build AI capacity, they're creating unprecedented demand for silver. Some estimates suggest AI-related silver demand could increase by 300% over the next 5 years. Electric vehicles are another huge driver. A typical internal combustion engine car uses about 15 to 28 grams of silver in its electrical systems. An electric vehicle uses 25 to 50 grams, but that's just the vehicle itself. The charging infrastructure requires even more silver. Every fast charging station contains significant silver content in its power electronics and circuit boards. As global EV adoption accelerates, this demand multiplier effect becomes more pronounced. Solar panels might be the biggest story of all. Each solar panel contains approximately 20 grams of silver in its photovoltaic cells. The metal is used to create the conductive paste that captures and conducts electricity generated by sunlight. There's currently no commercially viable substitute that matches silver's efficiency and cost-effectiveness. As governments worldwide push renewable energy targets, solar installations are exploding. The Silver Institute projects that solar panel demand alone could consume over 140 million ounces annually by 2027. Here's why this matters for mining stocks specifically. Industrial consumers need reliable, long-term supply relationships. They can't depend on spot markets or above-ground inventory. They need partnerships with producers who can guarantee consistent delivery. This is driving a new phenomenon. Industrial companies are looking to directly invest in or acquire mining operations. We're already seeing early signs of this trend. Technology companies are exploring equity investments in miners. Electronics manufacturers are signing long-term offtake agreements. Some corporations are even considering buying entire mining operations outright. This type of corporate demand creates a floor under mining stock valuations and can trigger bidding wars that send stock prices soaring. For shareholders of mining companies, this creates a win-win scenario. Let's talk about an opportunity that most investors overlook: junior silver miners. These are smaller companies, typically with market capitalizations under $1 billion, that are in earlier stages of development. They operate exploratory projects or small-scale mines that larger companies often ignore, and they're offering some of the most explosive return potential in the entire market right now. The Global X Silver Miners Junior Exchange Traded Fund, ticker symbol SILJ, tells the story. This fund tracks a basket of junior silver miners. In 2025, SILJ surged 195%. That's 46% more than physical silver's 149% gain, and we're just at the beginning of this cycle. Technical analysts are projecting SILJ could move to $24 to $32 by mid-2026. Why are juniors performing so well? It comes down to three factors: resource leverage, development optionality, and acquisition attractiveness. Resource leverage means that junior miners often have higher grade deposits or newer discoveries that haven't been fully valued by the market. When silver prices rise, these resources suddenly become economically viable. Development optionality refers to the multiple pathways juniors can take to create value. They can advance projects toward production themselves. They can joint venture with larger partners who provide capital and expertise. Or they can sell the project entirely to a major miner. Each of these paths can unlock significant value for shareholders. Rising silver prices increase the likelihood and attractiveness of all these options. Acquisition attractiveness is perhaps the most exciting factor right now. Major mining companies are sitting on record cash flows from high silver prices. They need to replace depleting reserves and grow production. History shows that juniors can deliver life-changing returns during precious metal bull markets. In the silver rally from 2008 to 2011, some junior silver miners increased 10 to 20 times in value. The key is selectivity. Not all juniors will perform equally. Investors need to look for companies with high-grade deposits, strong management teams, located in mining-friendly jurisdictions, and adequate financing. Companies that check these boxes have the potential to be multi-baggers. A well-constructed portfolio of 3 to 5 quality juniors could dramatically outperform both physical silver and the major miners. Right now, many juniors are still trading at depressed valuations despite silver's rally. This creates a window of opportunity. The liquidity is lower, so when buying pressure increases, prices can move very quickly. We need to talk about the geopolitical chess game that's unfolding around critical minerals, and silver is right in the center of it. What's happening goes far beyond normal commodity market dynamics. We're witnessing nations treating industrial metals as strategic weapons and defensive shields. This changes everything for mining stocks. China made the first major move in late 2025. They imposed export restrictions on refined antimony and other critical materials. But the message was clear. China was demonstrating its willingness to weaponize critical mineral supply chains. Silver is watching this closely because China processes a significant percentage of the world's refined silver. President Trump responded by setting a 180-day deadline to counter China's control of critical minerals. This isn't just rhetoric. The United States government is now prioritizing domestic production of strategic materials. Silver qualifies as a critical mineral because of its essential role in electronics and defense systems. We're likely to see policies that incentivize domestic mining and processing. Every country is looking to lock down exports of essential materials now. It's resource nationalism on a global scale. Australia is reviewing its critical minerals export policies. Canada is tightening foreign investment rules. Indonesia has banned exports. The trend is clear. Nations want to control their mineral resources. For silver miners, this creates a fascinating dynamic. Companies with assets in stable, mining-friendly jurisdictions become significantly more valuable. A silver mine in Nevada or Canada is worth more than an equivalent deposit elsewhere. Geopolitical risk premiums are being added to valuations. But there's another angle. When countries prioritize critical mineral production, they provide support. Tax incentives, streamlined permitting, subsidized financing. We're moving from a free market environment to one where governments are actively supporting domestic miners. The European Union is implementing its Critical Raw Materials Act to increase domestic mining. What does all this mean for mining stocks? It means that the value of a producing silver mine is increasing independent of the silver price. These assets are being recognized as strategic infrastructure. When assets shift from commercial to strategic categorization, valuations expand dramatically. Look at what happened with lithium miners when electric vehicle mandates made lithium a strategic metal. The takeover potential we discussed earlier is amplified by geopolitics. It's not just corporations looking to secure supply anymore. Governments are getting involved. State-backed investment funds. Smart investors are positioning ahead of this trend. They're identifying miners with assets in Tier 1 jurisdictions, companies that could benefit from government support programs, operations that align with national strategic priorities. These companies will be the first to see valuation re-ratings and the most likely to receive premium acquisition offers. There's a psychological pattern in precious metal markets that drives some of the most explosive moves in mining stocks. It's called the catch-up rally. Understanding this pattern is crucial for timing your investments. At the beginning of a precious metal bull market, gold typically leads. It rises first and fastest because it's the primary monetary metal that investors think of first. Silver is often overlooked in the early stages, but then something shifts. Investors who made money in gold start looking for higher octane opportunities. They discover silver is still undervalued. Media attention increases. Momentum builds. And silver begins its catch-up rally. When silver plays catch-up, it doesn't move gradually, it explodes. The moves are violent, fast, and can double or triple prices in months. Stephen Orrell, vice president at Orrell Capital Management, explained it perfectly. He said, historically, silver tends to lag gold early in a bull run and then experiences sharp catch-up rallies, which is what we're seeing now. We're in the early phases of silver's catch-up rally right now. Gold reached new all-time highs in 2024. Silver didn't participate initially, but in 2025, silver woke up. When silver catches up to gold, mining stocks catch up to silver. But they don't just match performance, they amplify it. This creates a cascading effect of outperformance. The leverage compounds at each stage. Market psychology plays a huge role. Early cycle, institutions buy gold. Mid-cycle, aggressive institutions buy silver. Late cycle, retail investors pile into mining stocks for explosive gains. We're currently in the transition phase. Institutions have recognized the silver opportunity. Institutional buyers are beginning to accumulate major positions. This is smart money positioning ahead of the retail wave. The retail wave hasn't hit yet. Most investors don't know silver crossed $90. When this awareness spreads and your neighbor asks about silver stocks, that's when the final parabolic phase begins. Technical analysis supports this. Silver broke resistance at 32 and 50. It's consolidating at 90. Next targets are $120 and $150. Miners will move multiples higher. Sentiment indicators show we're still early. Put-call ratios are neutral. Short interest is elevated. There's still skepticism. When skeptics capitulate and buy, that's when we get the final explosive leg up. Here's something most investors miss when analyzing mining stocks. Management quality and capital allocation decisions matter just as much as silver prices, maybe even more. Mining executives have several options when cash starts pouring in. They can increase dividends, buy back stock, pay down debt, invest in expansion, or go on an acquisition spree. The best returns will come from companies that prioritize returning cash to shareholders. Massive dividend increases signal shareholder-friendly management. The stock price jumps to reflect the new yield. Stock buybacks are another excellent use of capital. When a company repurchases its own stock, it reduces the share count. The same earnings get divided among fewer shares, increasing earnings per share. Debt reduction is less exciting but critically important. Mining is cyclical. Companies that pay down debt have flexibility during downturns and can take advantage of distressed opportunities. Production expansion is where things get tricky. Growth is good, but only if it's disciplined. The mining industry has a terrible track record of overinvesting at the peak of cycles. Management teams get overconfident. They overpay for acquisitions. Then metal prices fall and shareholder value gets destroyed. The graveyard of mining stocks is littered with companies that grew recklessly. The companies that will outperform are those showing discipline. Executives who recognize high prices might not last forever and return excess cash to shareholders. Watch quarterly earnings calls. Does management talk about returning value or empire building? Do they emphasize per-share metrics or just total production? These clues reveal their intentions. Some companies have already signaled their intentions. They've announced dividend policies that scale with metal prices and committed to debt reduction targets. These are the companies to own. The difference in stock performance can be dramatic. In previous cycles, shareholder-focused companies outperformed empire builders by 3 to 5 times. Same metal prices, completely different results. Position yourself in companies with proven management teams. Look at what they did during the last upcycle. The best predictor of good capital allocation in 2026 is good capital allocation in 2016. We've covered a lot of ground today, so let's bring it all together. Silver miner stocks have the potential to dramatically outperform physical silver in 2026. This isn't speculation. It's based on fundamental factors. Operating leverage gives miners the ability to amplify silver price movements. When silver rises, their profits rise much faster. This mathematical reality drives stock prices higher. The structural supply deficit continues to deepen. 800 million ounces of cumulative shortfall. Supply cannot keep up with demand. This imbalance supports higher prices. Industrial demand from AI, EVs, and solar is revolutionizing silver markets. It's about irreplaceable consumption. Tech companies need guaranteed supply and are willing to pay premiums. Junior miners offer the most explosive return potential. They're still undervalued. As attention shifts to producers, capital will flow into these smaller companies for multi-bagger returns. Geopolitical factors are adding strategic value. Resource nationalism and critical mineral policies are changing how assets are valued. Mines in stable jurisdictions are worth more. The catch-up rally is underway. We're in the institutional phase. The retail wave hasn't hit yet. That final parabolic phase is still ahead of us. Management teams will be the differentiator. Companies that return cash to shareholders will outperform empire builders. Watch for discipline and proven track records. So what should you do? First, do your homework. Research individual companies. Look at assets, costs, and management. Build a diversified portfolio. Second, consider your risk tolerance. Mining stocks are volatile. If that makes you uncomfortable, size your position accordingly, but recognize that volatility creates opportunity. Third, stay informed. New developments can change the landscape quickly. Follow company news. Track silver prices. Watch for policy changes. The opportunity is real. The fundamentals are strong. The trend is your friend. But opportunities don't last forever. The time to position is before the mainstream catches on. 2026 could be historic. The question isn't whether they'll outperform, but by how much. Will it be 2 times, 3 times, 5 times? The setup is extraordinarily favorable. Thank you for watching. If you found this valuable, subscribe for more insights. Leave a comment on your thoughts. Do your own research. Until next time, stay informed and invest wisely.